Have you ever wondered why the government of India is investing so much effort into programs like Make in India, Digital India, Atmanirbhar Bharat, PM Gati Shakti, and stricter rules for product traceability? At first glance, these policies seem focused on factories, highways, exports, and technology. But hidden beneath them is a much deeper objective: building trust. Imagine you walk into a grocery store and pick up a packet of milk. You check the expiry date. You buy a strip of medicine and verify the batch number. You purchase an electrical cable or a bottle of cooking oil and notice a QR code printed on the packaging. You probably never stop to think about it, because those tiny markings have become part of everyday life. Yet, those few characters quietly answer some of the most important questions a consumer can ask. Is this product genuine? Was it manufactured legally? Can it be traced if something goes wrong? Now pause for a moment and ask yourself another question. Who actually prints those tiny details on millions of products every single day? Most people have never heard of the company behind that invisible layer of trust. It doesn't manufacture the milk. It doesn't make the medicine. It doesn't produce the cable. Instead, it manufactures the machines that give those products an identity. That company is Control Print Ltd. This is where the story becomes interesting. Control Print belongs to a niche corner of the industrial technology sector known as coding and marking. The name sounds technical, but the idea is surprisingly simple. Imagine every manufactured product carrying its own Aadhaar card. Just as every citizen has a unique identity, every packaged product today needs a unique identity too. That identity is created using coding and marking machines. Every expiry date, manufacturing date, batch number, QR code, barcode, and serial number is printed by machines like the ones Control Print manufactures. Once you begin seeing the world this way, you realize something fascinating. Almost everything around you, from biscuits to pharmaceuticals, from dairy products to steel pipes, from electrical wires to plywood, needs coding before it reaches the customer. Suddenly, the addressable market, often called TAM or Total Addressable Market, becomes much easier to understand. TAM is simply the total business opportunity available if a company could serve every possible customer. Think of it as the size of the entire playground before the game begins. As India's manufacturing sector expands, exports increase, and compliance regulations become stricter, that playground naturally becomes larger. This creates what investors call a tailwind. A tailwind is like a strong breeze pushing a cyclist from behind. The cyclist still has to pedal, but the journey becomes easier. Government policies encouraging domestic manufacturing, increasing exports, digital traceability, food safety regulations, pharmaceutical compliance, and anti-counterfeiting measures are all powerful tailwinds for companies operating in this industry. But every story has another side. The sector also faces headwinds. A headwind is the opposite, a wind blowing directly against the cyclist. Global competitors poses advanced technology. Raw material prices fluctuate. Customers constantly demand better products at lower prices. Digital printing technologies continue to evolve. Businesses have to invest heavily in research while maintaining competitive pricing. These forces constantly test the strength of companies operating in this industry. Now comes the real question. If the industry itself looks promising, why should anyone pay attention specifically to Control Print? To answer that, let us use our first mental model. Imagine you own a coffee machine at home. Buying the machine is only the beginning. Every few weeks you need coffee capsules, cleaning solutions, servicing, and spare parts. The company that sold you the machine keeps earning money long after the initial sale. Control Print operates in a very similar way. Factories purchase its printers once, but every day thereafter they continue purchasing ink, consumables, spare parts, maintenance services, and technical support. Investors call this an annuity business model. An annuity simply means recurring income that keeps arriving again and again without having to find a completely new customer each time. It is one of the most admired business models because future revenue becomes more predictable. This leads us to another powerful investment concept known as the economic moat. Imagine two villages connected by only one bridge. Anyone wanting to cross the river must use that bridge. The bridge owner enjoys a natural advantage. Warren Buffett describes this advantage as an economic moat. In business, a moat represents a durable competitive edge that protects profits from competitors. Control Print's moat is not based merely on selling machines. It is built on relationships developed over many years. Once its printer becomes integrated into a production line, replacing it becomes inconvenient, costly, and risky. Customers continue purchasing consumables from the same supplier because changing systems could interrupt production. This creates switching costs that quietly strengthen the company's competitive position. As India's manufacturing base expands, every additional installed printer quietly plants another seed for future recurring revenue. Now let's shift our attention to management. Management's recent communication reveals an interesting shift in thinking. Instead of viewing themselves only as printer manufacturers, they increasingly want to become providers of complete traceability solutions. Track and trace technologies, QR codes, anti-counterfeiting systems, cloud-connected software, packaging automation, overseas acquisitions, and international expansion all point toward a much larger ambition. Notice something important here. The company isn't simply trying to sell more machines. It is trying to own a larger portion of its customers' operational ecosystem. That is a subtle but meaningful difference. Whenever a business successfully moves from selling products to solving problems, its long-term earning potential often increases. But investing is never about listening only to management streams. Investing is about asking difficult questions. One concern stands out immediately. Despite healthy revenue growth, profitability has not expanded at the same pace. Operating margins have gradually compressed. Return on capital employed has also softened compared to earlier years. Think of running a restaurant. If your restaurant doubles its customers, but your profit per customer keeps shrinking because ingredients become expensive or discounts increase, the business is certainly growing, but not becoming proportionately richer. This is exactly why experienced investors never celebrate revenue growth alone. Revenue tells you how much water flows into the bucket. Margins tell you how much water actually stays inside. This brings us to another useful mental model called the leaky bucket. Many businesses continuously pour more sales into the bucket while hidden leaks quietly reduce profitability. Great businesses eventually learn how to plug those leaks. Management believes price increases, higher value products, recurring consumables, and international expansion can gradually improve profitability again. Investors will watch carefully to see whether those promises translate into numbers. Now let us discuss valuation. Most beginners think valuation simply means checking whether the price-to-earnings ratio looks high or low. Reality is much richer than that. Think about buying a house. Would you judge the value of a house only by looking at its monthly rent? Of course not. You would consider the land value, replacement cost, future neighborhood development, rental income, construction quality, maintenance expenses, and resale potential. Professional investors evaluate companies using similar multiple perspectives. The price-to-earnings model asks whether today's earnings justify today's price. The PEG ratio goes one step further by comparing valuation with expected growth. A fast-growing business may deserve a higher multiple than a slow-growing one. The price-to-book model examines the value of assets already owned by the company. The enterprise value to EBITDA approach evaluates the value of the entire operating business irrespective of capital structure. The discounted cash flow model, often called DCF, estimates the present value of all future cash flows. Imagine receiving rent every year for decades. DCF simply asks, what is that entire stream of future income worth today? Another approach is owner earnings, a concept made famous by Warren Buffett. Instead of focusing only on accounting profit, It asks how much real cash ultimately belongs to shareholders after maintaining the business. Dividend discount models become relevant when companies consistently distribute profits through dividends, although for growing businesses dividends often play a supporting rather than leading role. Asset-based valuation looks at what the business owns. Replacement cost asks how much money a competitor would need to recreate the same business from scratch. Comparable valuation compares similar businesses operating in the same industry. No single valuation method gives the complete answer. Each acts like looking at the same mountain from a different direction. Only when several perspectives tell a similar story does conviction become stronger. Now let us quietly move toward technical analysis. Many people mistakenly believe technical charts predict the future. They do not. Charts simply visualize the ongoing battle between fear and confidence. Imagine standing on a beach watching waves. You cannot predict the next wave perfectly, but you can certainly observe whether the tide is coming in or going out. Technical analysis attempts to observe that changing tide. Recently, the stock has shown improving momentum after a prolonged period of correction. Volume, which simply measures participation, has expanded significantly. Think of volume as applause inside a theater. If only a handful of people clap, the excitement may not be genuine. But if the entire audience stands together, something meaningful is probably happening. Momentum indicators are also gradually improving. Momentum itself is nothing mysterious. Imagine pushing a child's swing. The more consistently you push, the higher it rises. Markets behave similarly. Rising momentum simply means buyers are becoming increasingly confident. At the same time, long-term trend structures appear to be improving. The stock is attempting to move from a phase of doubt toward a phase of optimism. Technical analysts often describe this as a transition rather than a destination. Yet, discipline demands patience. Good investors wait for evidence instead of excitement. Market psychology constantly swings between fear and greed. During declines, people imagine bad news will continue forever. During rallies, they imagine good news will never end. Both emotions usually exaggerate reality. This is why investing requires another mental model known as second-level thinking. First-level thinking says, the company is growing. Buy it. Second-level thinking asks, everyone already knows it is growing. Has the market already priced in that growth? What could surprise investors positively or negatively from here? That question separates investing from speculation. So where does that leave us? Control Print is not the type of company dominating television headlines every evening. It quietly operates behind thousands of factories, helping products earn consumer trust before reaching store shelves. It enjoys strong structural tailwinds driven by manufacturing growth, regulatory compliance, and increasing demand for traceability. Its recurring revenue model, healthy balance sheet, disciplined capital structure, and long-term strategic direction provide reasons for optimism. At the same time, investors must remain alert to margin recovery, capital efficiency, acquisition integration, and the successful commercialization of newer initiatives such as track and trace and packaging automation. Perhaps the most important lesson hidden inside this story has very little to do with control. Perhaps the most important lesson hidden inside this story has very little to do with Control Print itself. Whenever you study any business, don't begin by asking, will the stock go up? Instead ask, what problem does this company solve every single day? And why will customers continue paying for that solution 10 years from now? If you can answer that question with confidence, you have already crossed the biggest hurdle in investing. So the next time you hold a medicine strip, a bottle of cooking oil, a carton of milk, or a packet of biscuits, pause for just a second. Look at the tiny code printed on the package. Most people will ignore it. But now you know something they don't. Behind that tiny mark lies an invisible business quietly creating trust, generating recurring cash flows, and participating in India's manufacturing journey. And perhaps that is the most memorable investing lesson of all. The biggest opportunities are not always the companies everyone can see. Sometimes, they're the businesses hidden in plain sight, quietly writing the invisible stories that every product carries into our homes.
Don't forget to like and subscribe.